what is the most respected name when it comes to bonds? It's Bill Gross. He's now at Janus Capital, has been for quite some time, so let's get right to it. He's joining me now. Bill, I'm glad you're here on a day where the 10-year yield is dropping so precipitously. Right off the bat, I need to ask you, is that the play that you would recommend simply to preserve capital versus get any return on capital at this point?
Well, certainly. Even at 1.7%, that's a positive return, and the question becomes, do bond prices continue to go up, reflecting lower yields, or do they go down, reflecting higher yields? I think the Fed, for instance, in charge of the Treasury market, basically has to stay where it is, or maybe even lower interest rates, or have a renewed quantitative easing program at some point. So a Treasury 10-year yield at 1.7% on a long-term bond, basically are relatively safe, certainly from the standpoint of principal, and I think from the standpoint of market price as well.
Am I hearing you correctly? You feel that it is possible the Fed will be put in a position where it has to take back that quarter-of-a-point rate hike it put in December?
Yeah, I think at some point, and it's going to be difficult for them to do that because they've been walking up the expectations for several years in terms of raising interest rates, but it's obvious that on a global basis, and the United States and the Fed, is the global banker for the world, it's obvious that an increase in interest rates has dramatic repercussions in terms of risk assets, equity prices, and global bond prices. And so, I think at some point they're going to have to rethink what they've thought for the past several years.
We've got this massive sell-off in financials. So as they go into a tailspin, what's at work here? Is it simply the belief that net interest margins, there's so much pressure put on? See, banks actually like when interest rates are higher, for our viewers who don't know that, because then they can get more money on that. But it doesn't look like that's happening at all.
Yeah, I think that's right. Obviously they've extended loans, and we don't know how many and how much, to energy-related commodity producers on a global basis, not just here in the United States, but, European banks as well. I've heard mention that Credit Suisse and Deutsche Bank are at relatively significant lows. But the net interest margins that you mentioned, a bank and an investment bank needs a very positive yield curve. They need to borrow short and lend long at a decently wide spread in order to make the margins and the money that they've made historically. And when they don't, when the yield curve compresses and that margin doesn't exist, then banks are having problems. And so it's a two-front type of war at the moment.
Bill, I hate to invoke the R word because I'm an optimistic person, but are we going to go into recession here in the United States? Not because things are so horrific here, but because globally we have a slowdown that seems to be very tied to what we're doing here in the United States. Recession or not?
Yeah, I think in the United States we can stay above the line on a real growth basis in this particular quarter, maybe in the next quarter. What's important to me, and I think what should be important to central bankers, is nominal growth. They want not only real growth plus inflation. And, it's important in the United States to grow by at least 4% nominally. That's real growth plus inflation. And we've only been growing by 2.9%. So I think it's fair to say that, we might have a nominal growth recession over the next 6 to 12 months.
So, Bill, you said last week in your note you got to stick with plain vanilla if you're going to be safe. Let me throw these choices out to you. The greenback, which seems to be doing relatively well, treasuries, or quality, investment-grade quality junk bonds. Is there anything in there, or even gold, that you would say, okay, park it there, that's plain enough vanilla for you?
No, I think treasuries are very plain vanilla in the 5 to 10-year maturity area. Gold is subject to the whims of the marketplace, so to speak, and to a further decline in interest rates. Risk assets and even the dollar. I think at this point, if the market believes that the Fed will stop raising interest rates and maybe at some point, like I'm suggesting, begin to move in the other direction, then the dollar will be weak relative to the yen, relative to the euro, and even relative to some of the stronger emerging market countries. So I wouldn't be investing in the dollar at the moment.
Okay, yeah, that would be counterproductive. If the Fed has to put the brakes on and slam it, which you say it appears they will have to, you're saying stay out of the dollar. I have to then turn to just the worry overall for you. What worries you the most that people aren't watching but should, Bill?
Well, I think it's China, and you and others have talked about China ad infinitum for the last 6 to 12 months. But what is the growth rate in China? They claim it's 6 to 7%. I'm suggesting that perhaps it's much less than that. And China is a highly levered economy with too much debt relative to to their cost of funds. And so, I'd be looking at China. They've got a week's holiday here where we can't exactly look at their markets, but China is the engine for the global economy at the moment. And if China can't have significantly positive growth, then the rest of the world has problems.
Bill, we were talking in the break, and you said this almost looks like The Big Short Part 2. How so? That scared me. That made me worry.
Yeah, I think in a way, and not from the standpoint of a Lehman crash, but
right.
from the standpoint of too much debt. Back in Lehman days, the subprimes, there was too much mortgage debt, and the cost of that debt, as the Fed raised interest rates to 5.25%, was too high. I think what's happened now is that there's too much debt on a global basis in emerging markets, even in the United States to some extent, and the cost of the debt, basically is too high relative to what can be managed or what can be covered. And so to that extent, it's a Big Short Part 2. And what does that mean? Well, you should have shorted China 6 months ago, and all of the associated areas related to it, commodities, oil, anything that China wanted, you want to be short of.
I'm sorry, just to clarify, do you still feel that way? Would you be shorting China here?
Well, I certainly wouldn't be investing in it, and I'd be watching, as I just suggested, how fast they can really grow. Because if China can't grow at 4 or 5% like the market expects, then the rest of the world, simply can't grow as well. And some of the bad loans will become more obvious to energy companies and commodity-based companies, which is what China, basically has produced in terms of a bubble type of atmosphere. So I'd be very leery, and I'd watch China over the next few weeks to the extent that that's possible.
Okay, so stay out of the dollar. The Fed may have to reverse and cut rates. There's a lot that just was said in this interview that we really appreciate your perspective, because you've been a market participant for a long time. We're thrilled you're here. Thanks so much, Bill. Bill Gross.
Thank you, Liz.
Anytime. Bill Gross of Janus Capital.